Have you ever wondered why mortgages let you borrow so much, so cheap, and why personal loans lend small amounts but ask for much higher interest rates? Well, stick around if you want to find out exactly what the banks are thinking. One of the key features of debt is what it's secured against, or in other terms, what the lender can take from you should you not pay your debt. In this video, I'm going to explore the features of both types of debt and how you can use each to your advantage. Unsecured debt is debt without an asset that the lender can seize should you not keep up with the repayments. Lenders are less keen to lend to you when the loan is unsecured because there's more risk for them to factor into their calculations. As a result of this, they're likely to charge you higher interest rates. Unsecured debts are credit cards, personal loans, overdrafts, and loans from your family and friends. In all of these cases, the lender has lent their cash to you on the assumption that your income is sufficient for you to be able to keep up with repayments. But should that not be the case and you begin missing payments, the lender can charge you late fees and other amounts to penalise you for missing a payment. Despite all of this, interest rates are so low at the moment that even unsecured debts are still incredibly cheap. Best offers I can find for 0% purchase and balance transfer rates on credit cards being 24 and 33 months respectively, and unsecured loans being available at rates below 3%. Money is still, despite all of the uncertainty in the world at the moment, cheap even when it's unsecured. If you begin missing payments, this is known as delinquency. Any missed payments can make the loan delinquent and will adversely affect your credit score. After a certain number of months of non-payment on the loan, it could be classed as in default, at which point the whole loan becomes due, regardless of the terms you signed. For those of you who are watching who have a delinquent loan at the moment, defaulting on a loan is a serious thing. If you're burying your head in the sand because it's scary, the best thing you can do is pick up the phone to your lender and discuss restructuring your debt with them so that you can meet the payments. At the point that you default, most lenders pass the loan on to a debt collection agency. Debt collectors often purchase the loan from your original lender at a reduced value. The chances are they will try and take you to court and force a payment. Make no mistake, these people are not on your side. They are trying their hardest to make a profit from the debt they have bought. Crucially though, because your debt is unsecured, the lender or debt collection agency cannot take a car, house, or other possessions as collateral to compensate them for your inability to pay. There are negative impacts from defaulting on a loan, but the largest one that I can find is that a default notice is recorded on your credit file which remains there for 6 years. It's bad, but it is not the same as losing your home. Secured debt is different in that the loan is fixed to an asset you own, such as your home or your car. These assets are typically large in value to give the bank sufficient collateral should you cease to pay. Examples of secured loans are your mortgage, which will be secured against your home, and your car loan, which will be secured against the vehicle you bought. Mortgages have been at record low rates for years now, and some people who own a large proportion of their home have been able to borrow at rates which are below 1%. Bear in mind that inflation is supposed to hover at around 2% a year, and is currently far in excess of that. See my video about inflation for more information on that. Just showing in the top right. Banks are willing to lend to you at such a low rate because your home is seen as collateral. If you don't pay your mortgage, the lender can force you to sell your home, regardless of whether you live in it or not. I have linked below to a Citizen's Advice article, which elaborates upon the options open to you should your lender attempt to seize your property. It turns out that there are strict criteria to follow, and should you act reasonably towards a solution with your lender, you may be able to avoid losing your home. Another secured debt we'll all be familiar with is your car loan. These are typically secured against your car, obviously. The rates on these loans, though, are typically significantly higher than mortgages. This is because cars are what's called a depreciating asset, which means the value of your car will tend to decrease over its lifetime. This typically results in the value of your car being less than the value of the loan. The lender will be very wary of their security only being worth part of the loan. They also have the additional risk that should they need to seize the car as payment for the loan, they know that you still need a car. So you're going to have to make other arrangements to purchase a car, which will affect your disposable income and therefore the ability to pay back the remainder of that loan. The key feature with a secured debt is that if you can't pay, they will take your asset away. This isn't easy to do, but it's something lenders are well versed in doing. Lenders have the ability to take you to court, force you to sell your asset, or turn over possession of it to them. They can make you pay their costs of recovering, such as legal fees. And then, should the asset not be worth the full value of the loan, they can make you pay the additional amount owed over and above the value of the asset. However, once the asset's been sold, the company cannot sell your other assets. and must treat the remainder as an unsecured loan. Okay, so that was all pretty heavy stuff, but that hopefully explains in sufficient detail the difference between an unsecured and a secured loan. I hope you enjoyed it, and I present to you my most recent video. Have a great one, guys.